Should revenue include sales tax? One of the most common accounting and bookkeeping questions is whether revenue should include sales tax. The short answer is no. In most cases, revenue should not include sales tax because the tax collected from customers does not belong to the business. Instead, the business acts as an intermediary that collects the tax on behalf of a government authority and later remits it to the appropriate tax agency. Understanding the distinction between revenue and sales tax is important for accurate financial reporting and compliance with accounting standards. Revenue represents the money a business earns from selling products or services. Sales tax, however, is an additional charge imposed by state, local, or national governments and is collected from customers at the point of sale. For example, suppose a store sells a product for $100 and the applicable sales tax rate is 6%. The customer pays a total of $106. Although the business receives $106 in cash, only $100 is considered revenue. The remaining $6 belongs to the tax authority and must eventually be paid to the government. In accounting records, the transaction would typically be recorded as follows: asterisk debit cash, $106. Asterisk credit revenue, $100. Asterisk credit sales tax payable, $6. The sales tax payable account represents a liability because the business owes that money to the government. Since the company is merely holding the tax temporarily, it should not be recognized as income. Including sales tax in revenue can create misleading financial statements. If a company records sales tax as revenue, it would artificially inflate sales figures and make the business appear larger than it actually is. This could lead to inaccurate profit calculations and distort key financial metrics that investors, lenders, and managers use to evaluate performance. Accounting standards generally require businesses to report revenue net of sales taxes collected on behalf of third parties. This approach provides a more accurate picture of the company's true economic activity and earnings. It ensures that financial statements reflect only the income generated from the sale of goods or services. There are some situations where confusion may arise. Small business owners who review bank deposits may see the full amount collected from customers and assume all of it represents revenue. However, accountants separate the sales portion from the tax portion to maintain accurate records. The fact that the money temporarily enters the business's bank account does not change its classification. Different countries and jurisdictions may use various types of consumption taxes, such as value-added tax, VAT, goods and services tax, GST, or sales tax. Regardless of the specific system, the general accounting principle remains the same. Taxes collected on behalf of governments are not revenue because the business does not have ownership of those funds. Accurate treatment of sales tax is also important during tax preparation and audits. Misclassifying sales tax as revenue can create discrepancies in financial records and potentially lead to compliance issues. Proper bookkeeping helps businesses avoid errors and maintain transparency. Business owners should work closely with accountants or bookkeeping professionals to ensure sales taxes are recorded correctly. Modern accounting software often automates this process, making it easier to separate revenue from tax collections. Revenue should generally not include sales tax. Revenue represents the earnings generated from selling products or services, while sales tax is money collected on behalf of a government agency. By excluding sales tax from revenue, businesses can produce more accurate financial statements, comply with accounting standards, and gain a clearer understanding of their true financial performance.